Welcome back to our special MPC broadcast. The Reserve Bank Governor Lesitsha Kganyago announcing that the Reserve Bank has decided to cut interest rates by 25 basis points, taking the repo rate to 7.5%. I'm joined in studio by Elise Kruger. She's an independent economist, and Annaline van der Poel. She's the COO at Debt Rescue. Thanks very much, ladies, for joining us. Let me start with you, Elise. You're always quite critical of the Reserve Bank for being far too conservative. What do you think about this latest 25 basis point cut?
Yes, on the day, I think this is the best that we could have hoped for. I think there was no chance for a bigger cut than 25 basis points. However, if I look at the revised CPI forecast for 2025 at 3.9%, it's really surprising to me that they did not even consider to hike, to cut a bit bigger. Because really, if you look at that 3.9%, if you look at the 2.7% neutral rate, you are talking here about scope for further cuts in interest rates, and it doesn't sound like that is on the table at all.
Annaline, this is good news for consumers, especially those who are heavily indebted.
Indeed, it is. But, we've got to put it into the big picture and to say, okay, we're going to see a few $100 savings maybe on a bond or a vehicle. But looking at the current predictions, we're probably looking at a fuel price increase next week. So, they're just cancelling each other out at this point. So from a consumer perspective, good news, but not good enough, unfortunately.
So, Elise, I see that the governor was quite clear that he does see the inflation risks on the upside, really citing external risks or external issues.
Yes, indeed. So currently a lot of the global factors are very uncertain, especially since Trump has taken office. I mean, almost every morning one needs to look at what happened overnight in the US, or there may be some surprise announcements in terms of policy or tariffs. So yes, there's a lot of uncertainty, but I think we've got some fat built into our current inflation environment. If you look at our 3.9 forecast now towards 4.5 is a 0.6, a lot of things will have to happen, I would say, to the wrong side of expectations to push us a lot higher than 4.5. So there is definitely scope for us to still move in interest rates a bit lower, in light of the fact that we are seeing numbers that are closer to the bottom side of our target band. And this economy is still struggling to gain momentum. I mean, we will have for last year probably 0.8% at best in terms of real growth. We are trying to get the economy moving, and monetary policy could play a bigger role in that.
So, Annaline, as we get excited on the one hand about a rate cut, like you said, there are other pressures that come our way, almost cancelling out, that benefit. And we've just seen that NERSA has announced that it's going to allow Eskom to have a 12.7% increase for electricity tariffs. They were looking for a 36.1% increase, so thank goodness NERSA came to their senses. But of course, that's still way above the current inflation rate, so that's going to be more pressure for the consumer.
Absolutely. I mean, all these items just keep adding up. So from a consumer perspective, again, 12% is a lot of money on an absolute necessity. And we have to also then ask the question, there's a reason why NERSA asked, or why they've asked for this specific percentage. What happens in the event that they're not getting it now? What does that mean for our infrastructure and the future of, possibly looking at load shedding again, which again puts, businesses under pressure, puts consumers under pressure, and job stability and, work and unemployment. So there's a lot of factors we have to look at on the ripple effect on what this means. But, thank goodness, agreed, definitely happier with that than a 36%.
Absolutely. So, Elise, the governor kept on talking about administered prices. It's something that he's always raising, and Eskom's tariffs are one of those administered prices. So how does that, what's that going to do to the inflation picture? It's information that we've just got now. You haven't had time to really calculate it, but what does that do to the inflation picture going forward?
Well, if you look at the detail of inflation modelling, this 12.7% is now actually good news, because I think the Reserve Bank had incorporated a higher tariff increase, like 14.5%. So in the very short term, that could result in a slightly further drop in the forecast. But overall, as you mentioned, it's way above the average inflation rate. And from that point of view, it remains an inflationary component of the CPI basket. And I can just see in future that if we can incorporate more private electricity generation, you know, prices will come down. So once you get to a point where municipalities not only buy from Eskom, but also from, say, a renewable power project on the outskirts of town, which is, you know, a lower tariff, you can start to see a weighted average cost of electricity coming down. And then it will start to alleviate these pressures from administered prices. But where we are now, we are still seeing, you know, year by year, notably above inflation for, you know, increases for not only electricity, but also the municipality tariffs like water and so on. So we've got a problem in that regard, and government will have to come to the party in that sense. I mean, it's out of the hands, but where we do see private sector coming into play now, we can start to see those administered prices coming down over time. But it's not a short-term phenomenon. It will take time before we see that.
Yeah. All right, ladies, we're going to pause it there, and we're going to take a quick break. We'll have more for you after a short one.